and you're looking for great financing options in this market, today is your day.
You better get fired up.
All right, we got the man, the myth, the legend, Mr. Nate Joma. How you doing, Nate?
What's up? I'm doing great.
Life good?
Life is good.
Awesome, man. So we're going to get into some of the financing options that first-time homebuyers have today. I do want to start, though, with the big headline in real estate news, which is rates are dropping. In fact, let me look at my my Facebook post. I just put something up that I pulled off of Yahoo, because we all know how great of a source that is for news. Mortgage rates. This is the lead title of this. Yeah, I know what you're laughing at. Mortgage rates dropped by largest amount in 41 years. Tell us about that. What does that mean?
Well, I can't tell you exactly what that means because I don't agree with it. But I can tell you that last week on Thursday, we got the consumer price index numbers in, and they were favorable. And that led to a lot of sentiment that inflation might be starting to, get a little bit more reasonable. We'll stop seeing these crazy inflation numbers. And so what happened when those numbers came out at 8:30 Thursday morning is rates that day got much better because the markets responded immediately. They were celebrating the news. And so that day we saw rates, depending on the type of program you were looking at, drop anywhere from about 0.5% all the way down to maybe 3/4 or a full percent. Now, over the course of, Friday was Veterans Day, so the banks weren't open, the market wasn't around. Going into Monday this week, we saw some of that momentum carry. So Monday was a pretty good day. Tuesday was a pretty good day. Wednesday, things started to kind of level out a little bit more. Thursday, things went in the opposite direction a little bit. And then this morning, we're not seeing anything crazy happen, but we're not recovering from some of the losses that we had yesterday. So have rates come down over the course of the last week? Yeah, absolutely they have. I wouldn't say that there's been a dramatic drop or that they're at the lowest point. They're lower than they were the last several months. The good news is with those numbers coming out, I believe that we'll see rates over the course of the next 3 to 6 months start to slowly get a little bit more attractive.
What makes you think that?
I think that because I know that we have some things that are going to be coming up in the economic calendar toward the beginning of the year that should help us through Q1, maybe into Q2, see that we're going to have a little bit better pricing. I think we're coming out of the recession. I think that we're starting to see that the Fed has done a little bit to actually help us. What they've been doing under the guise of helping us over the last year has hurt us. But I think that they're starting to get it.
When you say that, are you talking about jacking up rates?
Yeah. So when they mess with the Fed funds rate, which is the cost that the banks borrow money from one another.
Yep.
Right. So Bank of America needs to remain liquid. They need to have so much in reserves in order to, be compliant. They have to borrow money either from other banks or from the Federal Reserve. Most of the time they borrow from the Federal Reserve. So that's also known as the overnight the overnight funds rate. So what's happening now is I think that there's a lot going on, but I think the Fed is starting to realize that the things that they're saying and the things that they're doing are sort of counterbalancing one another. We might see here over the next, like I said, probably 3 months, maybe 6 months, that rates are going to start to get slightly better. I don't want anyone to get excited and think we're going to be in the 3s and the 4s. That's absolutely not what I'm saying. I'm saying we're going to see that rates aren't going to continue to increase. We'll see that they'll either find this point of stability or there will be a slight decrease. What that's going to look like exactly, I couldn't say.
All right, guys, you heard it here first. Nate Joma said we're going to be in the 5s in the next month or two.
Absolutely not what I said.
All right, well, guys, whether you're watching on YouTube or Facebook, if you've got questions, comments, anything like that, please throw it down. As Nate's talking, I'll certainly throw them up, and we will address anything you've got. But, Nate, kick us off. Tell us about some things that home buyers, first-time home buyers specifically, can do or take advantage of in this market when it comes to financing options?
Sure. So they're the two primary purchasers of conventional mortgage rates. Excuse me, you got me talking about rates, Joe. Conventional mortgage loans are Fannie Mae and Freddie Mac. We refer to them as the agencies. They are the agencies that purchase the actual notes. And so what we're seeing from them, and this has been around for a bit, but they have two programs specifically designed for first-time home buyers who are under or at the 80% area median income. And that's a public number. We can find that number. And I actually did go and find those numbers for parts of Brevard and Indian River, St. Lucie, and Martin.
So you're saying these are in the bottom 20% of income earners?
No, sir. I'm saying that they are at the 80% mark of the area median income or less. So they're not necessarily in the bottom half. Let's say that the area median income is 100,000.
I got you.
These are the folks that make 80,000 or less.
Or less. I got you. Okay.
That's what I'm saying.
Yep.
Yeah. So I went and looked at, it's going to vary by address. They do block it out a little bit, but really the address is what's going to drive that. But I looked at parts of Martin County and St. Lucie County, and that 80% line is $67,600. So if you've got a single person or a couple and their gross annual income is at or below that 67,600, then they're good candidates for this specific program that's offered by, again, the agencies, Fannie Mae, Freddie Mac. So Home Possible is Freddie Mac's version of this program, and Home Ready is Fannie Mae's version. They look the same. They don't act very different at all. I mean, one can look just like the other. It's just they're two different purchasers of these loans.
Yeah.
But those have been around for some time, and those programs say that you can put down the minimum 3%, which you can do anyway, even if you don't qualify for this particular program. As a first-time home buyer, your minimum down payment's only 3%. Whereas if you've owned a home previously, it's 5%. The IRS defines a first-time home buyer as somebody who has not owned and occupied a primary residence within the past 36 months. So if you used to own a home, sold it, and you've been renting for some period of time, and it's been 36 months or more, you're classified by the IRS as a first-time home buyer.
Perfect. Okay.
Right. So that's what I want to talk about today. Some exciting things that came out that are going to drive some better results, lower, I shudder to say lower expectations, but to make it easier for first-time home buyers that are approved, that are qualified to be able to take advantage of some of these great programs that are out there for them. So there's a government agency that's known as the Federal Housing Finance Agency, the FHFA. And they're an independent agency that's part of the executive branch of government. They actually report up to Congress. So their goal or their function is to ensure that Fannie Mae and Freddie Mac operate in a safe and sound manner, and that's done through supervision and regulation. So they've come out and said to the agencies that they want them to make it a little bit easier for these people to be able to get into houses. So actually last month on the 24th, October 24th, they put out a press release, and it says that as part of the pricing changes stemming from the agency's ongoing review, agency in this case being FHFA, they are announcing that they are asking Fannie Mae and Freddie Mac to eliminate upfront costs for first-time home buyers that are at or below the 100% area median income. And they're also asking for them to be a little bit more judicious with offering the Home Ready and the Home Possible loans.
So let me ask you a couple questions there. You're saying they're looking at getting rid of some of these costs. Can you tell us specifically which? Because if you look at an Alta at the end of the day, you've got 736 different costs that totally your closing costs, right? Which costs specifically are they talking about?
Specifically loan level costs. So across the board, different lenders, I'm sure you've heard, are have what's called an overlay. So they might have different things that they charge that they bake into these loans.
Yeah.
So what they're saying is that they're asking that Fannie Mae and Freddie Mac not take these loans on unless the lenders are complying and eliminating some of these upfront additional costs that we see. So
The
part
overlay.
of going through one of the Home Ready or Home Possible programs is they have to take a home buyer education course. They've already made that free. It used to cost money to do that. They've already made that free. So that's part of that compliance. That's part of that piece. And then it could just be any other costs or anything else that's up front. It's not eliminating the, state taxes, the county taxes, the transfer taxes, the this, the that. It doesn't impact settlement costs. All of those things are still going to be. We're talking only about loan costs. So one lender to another, you'll see loan costs are going to be the only difference. When you're looking at purchasing a home, other than lender costs and loan costs, everything else is a static number, right?
Yep.
Because you're going to buy that house. It's going to be the same price for that house, no matter who you use for the financing, no matter which title company that you land with. The fees, for the most part, are going to be comparable. Everybody's going to have their own fees and things like that. But those things are more static and more locked in. Loan costs are what changes.
So let's go back to that where you're looking at median income and are you at 100%, are you 80%, whatever. Is there a website where these guys can look up the median income in their zip code?
They can. I have it bookmarked, but I believe, let me jump on real quick. If you Google,
I'm going to do it right now.
Fannie Mae, that's FANNIE MEEAMI, which is area median income. The first thing that comes up is the income lookup tool.
This one. Gotcha. Okay. And I'm going to copy. I'm going to come into the comments, guys, here, and I'm going to post this. And then what I'll do is I'll put that right there so you guys can look it up. So let me, I just, as a guy who has never seen this before, let me come in here and just play with it. Sure. So I live in enter address or 11 digit. Okay. I'm going to enter my address. Let's see what happens. Okay. So it's telling me 100% area median. So that is the median income. The median income where I live is 84.5.
Right. And for these programs, you'll see it says on there, Home Ready.
Yep.
It's the 80% line.
Very explicit, 67.6. So if we household, I assume, whoever's on the loan, make 67.6 or less, then we would apply for what we would, what's the word?
That's correct. It's key what you just said too, though, Joe. It's not just the household, it's who's on the loan.
Yeah.
So if you've got a husband and a wife on the loan, they collectively cannot exceed that. However, if you can afford to get the loan with just one or the other, you only have to put one on the loan and you get it to take advantage of this.
Gotcha. Okay. All right. That's cool. All right. So what else we got?
So that's the big news. I wanted to make sure that I shared is that those programs that you might have heard of before are now becoming more accessible, and some of the upfront fees that there may have been have now dropped off. What are the advantages of these programs, you might ask? Well, the first thing is not only does it give you the ability to put less down as a first-time home buyer, right? We talked about that earlier, the 3% versus the 5%. But if you are eligible for the Home Ready or the Home Possible program, then you also have available to you access to lower rates of interest. So rates we talked about at the top of the call are lower right now, but you have access to even lower rates potentially with these programs. And if you put less than 20% down, as we've talked about in previous podcasts, you have PMI, private mortgage insurance. When you have one of these programs that you're eligible for, the Home Ready or the Home Possible, you also have advantage to lower premiums on that insurance as well. So as a first-time home buyer who is at or below 80% of the AMI, you have access to potentially better rates and potentially lower mortgage insurance. So those two things translate directly to lower payments. The rate's lower, the PMI's lower, the payment's lower. It's math.
So can you tell me roughly what is the expectation on lower rates and lower PMI?
So again, we looked at it before, but pricing on a rate, what the price of that rate is, fluctuates from lender to lender depending on what type of margins they have kind of built into their pricing. So we have access for somebody that has access to these programs to have potentially better pricing, which could translate to an 1/8% better rate, maybe 1/4% better rate. It really all depends on the pricing that lender has for those rates. Fannie Mae, Freddie Mac, they say, these are our prices. If you want to get X rate, this is the cost.
Sure.
And then from there, lenders can add in a little bit to make sure that they're able to, get a little bit of money, because that's how lenders are in business, to make money.
No.
I don't think that's a surprise.
Now you're not, are you, not you, are lenders baking in profits on PMI as well?
No, they can't.
Okay. So
No,
with
they
PMI, talk to me about how much better that might be.
So it's a little bit better. So we have 6 primary insurance companies, that's private mortgage insurance companies, that most wholesale brokers and mortgage lenders go to. And we look at whatever their premium is. So everybody has homeowners insurance if you own a home. You have auto insurance if you own a vehicle.
Yeah.
It's an insurance policy. So we go to insurance companies. It's not something that the lender has control over. If the lender wants to kind of keep that cost in-house, they could, of course, do that. But I don't believe that they would be able to do that without also having the same regulation that they can't they can't jack that price up, right? So most lenders do not. I can tell you right now, I know most lenders do not have that as in-house. It's outside. So these insurance companies have negotiated rates that are lower for folks that are doing these these home possible and home ready loans.
So how are we talking? $20, $40, $60 a month?
It depends. So the premium, the rate itself is going to fluctuate. So that translates directly to if somebody is buying a $600,000 house or a $400,000 house. So the money is going to incrementally change depending on that.
Okay.
So for example, let's say that your premium is at a 20 basis point. So $100,000 house, 20 basis points is, I shouldn't be doing this live because I can't do this in my head.
No, man, it's cool doing it live.
So that's $200. So let's say that it's $200 a month for this guy. But now I'm instead of being at a 20 basis point, premium, I'm at an 18 basis point premium. So in that case, it would be $180 instead of the $200 a month.
So you're saving $20 a month, and that's on how much?
That's on 100,000.
That's on 100,000. So if you're looking at first-time home buyers in my market tend to be in that $300,000 to $400,000 range. That tends to be, I would guess, I don't know, 70, 80% of first-time home buyers. So let's just say $400,000. You potentially are saving $80 a month through this program just in PMI. These are rough numbers.
Well, that was an annual cost. Sorry.
Oh, that's an annual. Okay, so you're saving $80 annually. You're also saving on the percent down. If you're able to go from 5 to 3, you're saving on a $400,000 home $8,000 in cash that you need out of pocket. And I don't know if you can do this live. I'm sure you can. What is an 1/8 of a point? That's about as small as it gets. But what if that's what it's saving you? What's an 1/8 of a point on $400,000 going to save me a month?
I can tell you right now.
Look at this guy.
Just bear with me while I pull it up.
This is why I love him, man. He can crunch numbers fast. Yeah. This is the stuff people want to know, man. All these programs sound cool, but I think when you can put, numbers to the benefit and people can see how juicy it is, to me, man, that's what makes it tasty or not tasty.
Absolutely. So we're talking about a $400,000 loan.
Yeah.
So we go from 20.
Look at him go, guys. Smoke.
I'm doing the math.
Yeah.
This is live, bro.
Live. Dude, do you have a blue light going on in your background?
I do.
Now, over by your window, is that a yellow light or is it just yellow for some odd reason?
It's just the sun. God's doing it.
I love that. I'm putting together my studio right now. So you're only going to see this dull, boring background for about another week or two.
Yeah.
And then we're going to amp it up. But my nerd, his name is Jorge, guys. I put a post up about him the other day. He's incredible. He's got a blue light and a yellow light, and he claims that's all the rage. So we're going to see what all the
I can change the colors right now. You want me to put yellow? I'll go yellow.
Well, it looks like you've already got but I think it sounds like God's helping you out there, but you've already got the blue and yellow that he's suggesting. Just naturally. It's a God-given. Whoa! All right. Well, I thought I worked with you for numbers reasons, but now we've got numbers and colors. This is
so
like
in that example that we talked about, an 1/8 of a percent better rate basically would save you about $33, just roughly.
A month?
Monthly.
Dude, so you're talking $80 total in PMI a year, plus you're talking about, what'd you say, $33?
$33, yep.
Dude, that's another $400. So you're talking about $500 plus you're saving me $8,000 in cash out of pocket. That is no. Oh, thank you so much. I appreciate you. Lunch is served. Don't tell anybody my kid's staying home today. But yeah, so that's a pretty sizable savings, man. If I'm a first-time home buyer, that's no joke, especially like we're talking, at least in my zip code, that's somebody making 67 grand or less.
Right.
That's a big chunk of change for someone like that. I like that. For
sure.
That's interesting.
For sure.
That's a good deal. So if I'm either in the market to purchase or I'm kind of on the fence and something like this might be the thing that puts me over, what's my next step? How do I figure out what the numbers actually look like so I can make a decision?
Yeah, so if you want to crunch those numbers, there's a couple ways that you can do it. You can pull up a mortgage calculator online and try to fumble through it yourself, or just give me a call. I'll be happy to go over those numbers with you. It doesn't cost anything to kind of have that initial consultation. I like to call it a hopes and dreams call because for me, I'm deep diving into what are your hopes for getting a mortgage? What are your dreams for, what you want to do with this house? And I take every single hopes and dreams call very, very seriously in terms of being able to really pinpoint if this mortgage is going to be right for you or if it's not going to be right for you. So, I mean, we ask some questions and we draft it out. Yeah. The whole time we're on the phone, I'm feverishly writing notes so that I can understand what somebody wants to do.
And I'll tell you guys, I've done this a lot. Nate's done this a lot. What I see more successful buyers, and I don't mean success in terms of money. I mean success in actually getting out there and successfully purchasing a home that fits what they want and being comfortable throughout the entire transition, right? What I see them doing that I see less successful buyers doing is really getting a hold of what they're facing up front, right? Creating those expectations up front. Oh my gosh, there's more. Okay. That's good, bud. That's all I need. I appreciate you. But if you can figure out what those numbers look like on day one, and a $300,000 home is this much out of pocket, there's really only two things I'm looking for. How much out of pocket and what's it going to cost me every month? Once I know that, I'm pretty confident, right? So Nate's going to look at your income and your debt and your credit and, he's everything. He's going to look at it all and he's going to give you different options. Those options are going to be thrown at you. And now you've got a real life scenario. This is what 300 grand looks like. This is what 400 grand looks like. This is what 500 grand looks like. Maybe he won't let you shop up to 500 grand. Maybe you're only allowed to shop up to 450. Cool. Now I just saved all that wasted time of me looking at homes that are 550, 600,000. And now I'm looking at 450 because that's what Nate tells me I can go shopping for. It also allows me to look at my budget and say, this is what I'm currently spending. This is what my new job's going to look like. This is what my budget looks like. This is what forget Nate, man. I tell people all the time, before you go talk to a guy like Nate, decide what you can pay in a monthly rate, or not in a monthly rate, in a monthly payment. I can't tell you how many people will say, hey, I can afford $2,500. And then they go talk to Nate, and Nate says, we will approve you for $3,200 a month. And they're like, dude, it's Christmas. This is great. Dude, forget $3,200 a month. If you told you that you can afford $2,500 a month, it's just phenomenal news that you're approved for that amount or more, right?
Exactly.
$2,500. If it goes the other way around, do you think you can afford 32? Nate says 25. Well, now, thank God you're looking at homes that are $2,500 because it doesn't matter what you think. Nate's not going to approve you anyway, right? So now
Right.
you're not wasting time. So I guess the short of it is, if you're in a position where you want to make a decision, go sit down with Nate and run the numbers. Now I'm going to tell you, Nate, this is what I hear from every single buyer who's on the fence. They're not like ready to roll. Well, I don't want to talk to Nate because it's going to hurt my credit. What do you say to that?
Yeah, I think that's one of those things also that kind of gets steamrolled in our industries, that every time you have somebody look at your credit, it's just going to. The fact of the matter is, in order for us to provide you with a full pre-approval, we need to look at it. What the impact of looking at it is in terms of the numbers is, you'll see that it'll impact your numbers anywhere between 1 to maybe 4 or 5 points. And that opens up a window of approximately 30 days where you can have other mortgage folks look at your credit as well. And it's a singular impact.
So let me ask you this. Let's say whatever loan product I'm looking at, it needs a 700 credit score. And let's say I got a 702 and this dings me 3 points and now I'm at a 699. Am I out of luck?
Not at all. Not at all. There's not going to be an impact to your credit that'll take you from being able to afford this or qualify for this and knock you down to that. It's not. The credit is one. It's a major part, but it's one part of these decision-making processes.
Yeah.
Everything is not driven singularly or solely by your credit, your income, or your assets. There's a lot of different things that go into it. Does somebody qualify or do they not qualify? Yeah. Credit's important. I'm not going to downplay it. It's really important. It's one of the major ones, but there's not going to be something that's going to take you from yes, he qualifies, to absolutely not, he does not qualify. And I'll tell you, if you think that you're on the cusp, before we ever have that conversation, I'll walk through the realities with you of, if you are on the cusp, here's potentially what we're looking at. And however, if your credit pull impacts you to the point that you're going to come to this, we may not want to pull your credit yet. We may want to talk through, why do you think your credit is where it is? Do you have collection activity? Are you late on payments? Did you have a repo? You know, I ask those questions, and that's part of that initial hopes and dreams call. Before I run out and pull somebody's credit, we talk through these things. If I say, what's your credit? And you tell me you think it's a 580, I say, why do you think it's a 580? That's what Credit Karma says. Okay, but why does Credit Karma say that?
Yeah, what do you not?
Credit Karma is not a good indicator of what your credit score is.
Yeah. What about my FICO score? How good is that?
There are 26 different scores out there. When you're looking on those credit apps where you have My FICO or Credit Karma or CreditWise, those numbers are your consumer credit. Those do not translate directly to mortgage credit. Unless you're physically looking at your mortgage credit scores, none of those numbers are going to line up correctly.
Okay. Well, listen, man, I really appreciate this. I think this is the kind of thing that first-time homebuyers especially need to hear to help them either move forward or say, you know what, it's just not the time. I don't have the ability to do this. But at least to be decisive, right, and move on in either direction confidently. That's what at least I want to achieve with people, is confident decisions. So just want to say thank you for all the insight. I appreciate it. Guys, if you want to find Nate, he's all over YouTube. You can find him on Instagram. He's on Facebook. He, much like me, is here to help you. If it ends in a sale and we make money, awesome. If it doesn't, and all we're doing is helping you make more confident decisions, even if it's with another realtor, even if it's with another lender, awesome. Yeah. We just want to see you guys succeed and make good, confident decisions. So, Nate, I appreciate you, brother. Thank you so much. We've got Nate on every third Friday of the month, so he'll be back again. If you guys have topics that you want him to discuss, let us know in the comments, even after the show has ended, and we will absolutely bring it up. If not, Nate will come back with another great topic. Thank you, my friend. I appreciate you.
Thank you. I appreciate it.